is a combination of the guy called James Tilstead and SMC, but not SMC as the SMC you know, so don't run off. I took out the parts I do not need, and then I also implemented the James Tilstead strategy to it, completely different from what the original. These are all minor structures. These are the minor highs and lows. Let me put it in the way most people say it: noise. Forex is not the same thing as any other market. Forex is different. And why is Forex different? You're going to find yourself holding a trade that will end up producing 1 to 2, 1 to 3, 1 to 4, 1 to 5, and roughly infinitive, because it's... Alright, so this video is all about the indicator I shared on the group, how to use it and how to trade with it and how to read it also. Understanding everything that has to do with the indicator, the way it works, the different strategies it encompasses, and how it's supposed to work. Now, if you don't know what I'm talking about, I would say join the Telegram group. The link is in the description below, and let's head right into it. When you download the script, it's going to come up as a notepad. What you simply do is you copy the notepad, copy what you have inside. You come to your Pine script editor on TradingView. You could also see it on the web, and you go for a new indicator. Simply go for a new indicator, copy everything just like this, and remove everything here and just paste it. So when you do this, I'm going to turn off the one I already have. Right, this is the clean chart. This is a clean chart, right? So what you do is you hit on the play icon. When you hit the play icon, what happens is the compiler compiles it and finally imports it onto your chart. You could save it by hitting the save script and save it with the name. I already have it saved. When you save it, what happens is it becomes part of your script. So if you go to your indicator, my script, you scroll down, you'll find James Tilstead plus SMC flow. Now, credit where credit is due. This strategy, this indicator is a combination of two things, right? Just like the name entails, it's a combination of the guy called James Tilstead and SMC. But not SMC as the SMC you know, so don't run off. It is more of simply the market structure of SMC. So that's why it's called SMC flow, not like SMC itself. Also, credit where credit is due. The SMC flow came from a person. I saw it here yesterday. This, where is it? This one. So this is where I saw it yesterday. This indicator has a lot of things. I'm going to turn off the one we're looking at, and you see it. So it has a lot of things. So when I looked at the indicator, it did have like a lot of good things, but it also had a lot of things I did not need at the point in time. Well, I currently still don't need it anyway. So what I did was I took out the parts I do not need, removed it from the indicator, and then I also implemented the James Tilstead strategy to it to then give me something like this. So you can see how this is different from, completely different from what the original SMC flow is, and also different from what the ordinary James Tilstead strategy is on its own. So how do you understand this whole thing? To understand it, you need to understand the two different parts of it. You need to understand market structure, and you need to understand James Tilstead. Market structure, just in case you do not understand what market structure is, I'm just going to give you a quick explanation in this video. Market structure is understanding the actual swing highs and swing lows of the market. Why do I say swing high and swing low? Why didn't I just say highs and lows of the market? Well, this is why we say swing highs and swing lows. In every time frame, there is a swing high and there's a swing low, and then there are minor highs and then there are minor lows in every time frame. So just like I'm looking at this time frame right now, in this time frame, if you ask anybody to just draw around market structures, like let's say a random person who doesn't know market structure, you tell them to draw out market structure on this chart, what you're going to end up seeing is something like this. The person will do this and they'll do this. I'm just going to do a quick rough drawing. So this is what the person will end up doing. They'll just highlighting every high and low you see on the charts. This is drawing market structure the way some people would look at it. I'm not saying everybody, I'm just saying very few sets of people. So this is what they will draw, which is not wrong. To be honest, it is not wrong. It is the entirety of the minor structure that this is a minor structure situation. The person is drawing every single high and low they see on the chart. What is swing structure? What is the swing high and swing low? Well, swing high and swing low is these are the places where price have to literally take out before you say this market is in an uptrend or is in a downtrend. For example, just by looking at this chart the way it is right now, it is obvious that if price takes out this low right here, it is clear that we are in a downtrend, right? Everybody would agree that we're in a downtrend. And if price takes out this high, I'm going to have to hide these things. It's also obvious that if price takes out this high right here, well, very clear that we are in an uptrend. However, this is the mistake. If you're just looking at this specific place to determine a high and a low like this, you've missed a lot of things already, right? Because when you go back and you say this is the high, this is the low, you've missed a lot of things again inside it. So how did you determine swing structure? Because it's looking like it's now objective rather than subjective. So to make it subjective, to make it specific, it goes like this. You start with, on your chart, this is clearly what it is. You start with this low. You start with one end of it. You don't start with both ends. You don't draw the highest and the lowest. You start with one end of it. So you start with, let's say, the highest part of it. In this place, let's start with this one. This highest part of it, right? When you start with this high, you're going to look behind this high. Where is the lowest point that led to this high before, just after break of structure? After a clear break of structure, you have this low right here. This is your original swing high and swing low. So this is your beginning of this whole situation. This is where you use as your genesis. Take note, this was the break of structure before it. This was the break of structure. Hence, we started to take note of this high, okay, this low. Now, price broke below the low. Obviously, price broke below the low and made this low. So this becomes your new swing low. And if this is your swing low, when price takes it out, where is the highest point inside this entire range? So you look at this range like this and you ask yourself, where is the highest point? It's right here. So this becomes your new swing high. Why are we doing it like this? Why in particular do we take this? What happened to every other move this person drew inside here? What happened to them? Simple. These are all minor structures. These are the minor highs and lows. They are basically, let me put it in the way most people say it, noise. That is just what it is. That's what they call it. They call it noise. It's not really noise, but compared to what you're looking out for, it's noise. So take a good look at, sorry, excuse me. I'm just getting well. So watch what happens here. What you're using the minor structure to do, because it's not useless, is that you're trying to determine what price is currently doing. That is what minor structure is meant for. And then major structure or the swing structure is what price is majorly focused on achieving. So there's a difference between I want to own a farmland and I'm going around looking for purchase rights or C of A's and the rest. So the swing structure is the swing high, swing low, that is the swing structure, is the overall direction, the overall strength, the overall movement market is making. But the minor structure is the current smaller move market is going to make or trying to make to achieve that main move. That is market structure at its core. So SMC flow, I have literally explained it to you. Now, if I turn this on, we already know market structure is understandably knowing the swing high and swing low, one. Secondly, understanding that when price makes this situation, again, this is it. So I'm going to draw this whole thing in lines. So when price makes this low, swing low, to the swing high. So this is this swing high. And then price broke below this low. So this is this swing low right here. Price broke below the swing low. We expect, right? We expect one thing. Price will pull back into the entire leg. So price will pull back, which is as what you can see here. So from this low, price pulled back. And then we expect price to, when it pulls back, at some point, continue the move. Why? Because we had the last break of structure to the downside, another break of structure at the top here. So price breaking structure to the downside, meaning price wants to continue to the downside. On this time frame, don't forget, it is time frame specific. So on this time frame, we expect that the swing structure is going to continue to the downside. So you can see what from here, price went what? Price went down. So this is, so all in all, let me draw the swing structure you see on this chart. So on this chart, we have this high to the low, to, I'm going to have to hide this again, to this high, all the way to this low, to the high, and finally this low right here. That is the swing structure you want to know of. I'm going to make it red, make it very bold. Actually, I think yellow is better, and bold. So you can see this and this are both the same thing. So now you understand the swing structure and swing market structure. When price does the opposite, let's flip the whole chart, inverse the whole chart entirely. So when price does the opposite, we're expecting price to continue to the upside. So this is the flips chart. So you can see price made a low right here. You can see the low, and then price made a high, right? And then price made a lower low. So high, lower low by breaking the low, and then price ended up breaking the high. So price created a higher high, and price did what? Pulled back, made a higher high. Now, all of this is understanding standard market structure. If you understand standard market structure, then you understand what the SMC flow here is all about. So if I turn this on, I want you to, the reason why I'm not editing the stuff yet is because I want you to see it exactly the way it is. I'm going to zoom into this chart. And then I'm going to flip it back to what it's supposed to be. And I want you to what? Observe. Did you see higher high, higher low, higher high? We're expecting a higher low, right? But if price doesn't make a higher low and price makes a lower low, as you can see right here, price went down to what? Lower low. If price makes a lower low instead of a higher low, then price has broken structure. It is now a change of character. Hence, we're looking at price to make a lower high, right? You see price pulls back. It's called a higher low because of the tolerance level. And then price what? Price made a lower low. So now we are expecting what? We're expecting what? A higher low. And then after a higher low, we are expecting a lower low. That is basic market structure understanding. I'm pretty sure you understand it to the best way you will ever understand market structure from this small lesson I just taught here. Now, with all of this in your head, making sense that you understand all of this now, what is the next thing you need to understand? You need to understand that this indicator shows you higher lows, higher highs, lower lows, lower highs, change of characters. So change of character is BOS, and then opposite break of structures, which is change of characters, and then break of structures. That is the first part of this whole thing. The next thing you need to understand is the band. The band here is simply all about what direction the price is moving on average. So it's more like, it's like a smooth average, moving average situation, but it's not a smooth moving average. I don't even want to explain that. It's a long story. Now, where is the James Tilstead coming from? I'm pretty sure you're seeing this thing on the background. This thing on the background is making the chart look smaller. We can turn it off and on by simply closing it here. You can see when you turn it off, then the chart becomes neat. When you turn it on, the chart looks a bit cluttered. So what is this meant for? So by standard of research from James Tilstead, what he said is this. He has observed that the best place to place your stop loss is when you multiply ATR by 3, and then you add or subtract it from current price or close of price or price close. So what I did was I simply run a calculator that does ATR multiplied by 3, right? And then projects it, the minus side on the downside, the plus on the upside. So you can see ATR multiplier. If I increase this number, you notice the band becomes wider. And if I reduce the number, the bands become smaller. So basically 3 is the best figure he ever attributed. So 3 is what I use for the band. And what is the band meant for? The band is meant for stop losses. So it's the best place to place, one of the best places to place your stop loss away from your entry is ATR multiplied by 3 plus or minus price, depending on the direction of the trade you're taking. Now, understanding market structure, understanding the stop loss of James Tilstead. How do you now understand James Tilstead's strategy? James Tilstead's strategy is simple. James Tilstead's strategy simply says this, first and foremost. First thing is, Forex is not the same thing as any other market. Forex is different. And why is Forex different? I want you to take a good look at every other market here. In stocks, you're trading one item. In funds, you're trading one item. Even if it's a combination of like S&P 500, it's a combination of so many things averaged to become one item, right? In futures, you're trading same thing. Oh, sorry, leave this place. One item. In not crypto, let's go to indices. I'm going to explain why not crypto. Here, you're trading one item. Sometimes comparison of item. Sometimes, very few, but look at it. VIX, one item, one item. Bonds, it's single items. Economy, it's simple, still the same thing, one item. Options, one item. That's what you need to understand. Forex and crypto are the only places where you are trading comparison of two items. Take note, BTC USD is BTC as Bitcoin against the dollar. You can see this is the only place you start to see the slash. Even this one that is written just BTC is a bloody lie. It's BTC against the dollar. So you see the slash start appearing, or you see the versus sign, versus this slash this. So crypto and Forex are the only places where you run comparison. The only difference is that crypto doesn't really have a fundamental stance of its own compared to Forex. The fundamental stance is now well registered all over the world. Now, you're trading Forex, a market that does a comparison of one item against the other. How do you trade that kind of market? It's simple. Again, I usually say it's simple a lot of times, but it is simple. What are you doing? You're looking for example, in this case, we're using the euro. I think I'll leave it in caps, all caps, and the US dollar, right? So you're trading these two currencies against each other. You're battling against each other. Like it or not, it's a battle. The smartest time you should ever buy euro compared to the dollar is when the euro is strong. Oh, I wrote strong. It's when the euro is strong and the dollar is weak. This is the smartest time you would ever buy the euro against the dollar. Basically, it's the smartest time you will ever place a buy entry on euro USD. Another time where you have smart trade is when the euro is weak and the dollar is strong. So this is the second smartest time you would ever place a trade. And what trade are you placing here? Well, this is the smartest time to buy the US dollar by selling the euro to buy the dollar. And that is you placing sell orders on euro USD, shorting the market. You understood this whole situation, right? Perfect. I believe you did. But let's move on. The strategy is all about detecting when one is strong and the other one is weak. That is what the strategy of James Tilstead is all about. Now, when it detects it, it gives you a signal to buy the strong one. So it's either telling you buy this market now or sell this market now, instantly, after detecting the whole situation. And how does it do it? It does it on the back end of the scripts. It's a long story. I don't want to go through it. It's a long story. The short form is it detects for the base and the quote. What is the base? Is it strong? Is the quote weak? If both of them are, for example, let's say this euro is strong, but the dollar is slightly strong. So not so strong as the euro, but slightly strong. I think I'll ask you this question. Should you buy the euro against the dollar in this case? If your answer is yes, then you're wrong. I'm sorry, but you're wrong. Why? Because let's draw a chart of what strong really looks like. Strong is price is doing this. and week is price is doing this, right? If you draw a comparison of these two charts, right? You draw a comparison of these two charts. If this is the base, you will have a chart that looks like this. You can see how nice and clear it is. If you do the opposite of them, you'd get the opposite chart. I don't need to draw that one. But when both of them are strong and slightly strong, so one is going up like this, and the other one is going up too, but it's going up, let's say, slowly. Do you think you will get this kind of chart? No, you will not get this kind of chart. What you will get is a chart that looks like this. Yes, it's still an uptrending chart. However, do you see the difference of the move? This is clear move. This is weak move. So again, you want to buy because the move is clear, not because one is stronger or slightly stronger or weaker or slightly weaker than the other. So you want to buy when it's really clear. So in other words, these two areas are not important to you as trading James Tilstead strategy. That is simply what it all entails. Now that you understand this whole shenanigans, this whole thing, let's now look at the indicator itself and what it really does on the chart. We've been able to detect and understand the higher highs, higher low, the bands, but where is James Tilstead's strategy in this whole place? Well, you see these arrows here, not this one. This is SMC sell, basically the market structure sell situation. This is telling you that market structure falls more on the selling side because it has gone below the average of the current move, right? But this one right here is where the market did everything you needed to do. So let me give you an example with this particular one right now. This particular candle shows you one thing. It shows you that the strength of the US dollar, in this case the base currency, is strong, and then the strength of the euro is either flatline or negative. So automatically the dollar is stronger. At the close of this candle, the dollar was very clearly strong. And how do you even know this is real? Like, how do you know this is strong? Well, I extracted James Tilstead's strategy after creating a formal indicator. This was the original indicator, but this original indicator required me to have this and have the ATR on the chart and all of that stuff. And I don't want to have it so many things. I decided to put the ATR and this into a simple overlay that gives me instant arrow and ATR. We've removed the ATR, so this is exactly what it is. Now, when this is red, it means I'm going to make it even better for you to see and make it much more visible. Let's make this a column chart. Make this full screen. So when the bars are red, it says the base is strong, the quote is nullified, either zero or weak. When the bars are green, it means the base is strong, the quote is either nullified or weak. When the stuff is gray, it means both of them are moving in one direction, but the base is stronger. So when it's gray upwards, it means the base is stronger, but they are both moving in similar direction. When it's on the downside, it means the quote is stronger, but they are both moving in similar direction. Now, the strategy is focused on making sure it gives you signal when the change is obvious, and it's not just any kind of change, but specifically that one is stronger and the other one is going weak. That is simply what it is. So you can see the different times when the arrows appear here, very small arrows. You may not see it all that clearly if you're using a phone. I advise you use a laptop or a monitor. You see this is red, you see this green here. Now compare it with where it appears on the chart. You can see it directly on the chart right there, directly on the chart right here. So you can see even though the candle was green, but what was happening on the back end is that the strength of the US dollar was outpacing the strength of the euro, and that was what we have here. At the same time, it's calculating the stop loss range. So this is where your stop loss is supposed to fall in, and then you take a trade. Now, unlike a lot of other strategies that tells you 1 to 2, 1 to 3, I'm using a core view of James Tilstead and This is also why I'm using market structure. According to James Tilstead, you're supposed to enter the market and manage trade. You don't enter and plan to exit tomorrow. No, you're supposed to enter and manage the trade. Why? You are trying to hold the market until the market clearly flips to the other side. Meaning, you're trying to, when you enter a trade that you feel the euro is stronger than the dollar, which is a buy trade, you're going to hold that trade until the market starts to show you clear signs that the dollar is now stronger than the euro. So a complete flip. Now it doesn't mean that doesn't mean you're going to hit this sell. Let's where is it? We're going to hit the sell here. Let me look for it. Once I see this line, I know it's an arrow. So there's an arrow here actually. Funny enough, there's an arrow right here. We're going to hit the sell right here. So it doesn't mean you're going to place a sell here. And then whenever you see a green indicator, you dive in. So like right here, you have a green indicator. It doesn't mean this. No, this is not what it means. That's not how you trade it. The way you trade it is when you enter the market, whether it was a green or red you used in entering the market, but once you enter a market, you totally ignore anything that has to do with entry. You switch into trade management. What is trade management? Well, you simply follow your trade based on market structure. That is trade management. There are so many ways. You could follow your trade based on specific range close. You could follow your trade based on targeted area. But the smartest way you can follow any trade and manage any trade is market structure. It's the smartest way you can manage any trade. Any strategy you are using to trade at all. Just try using market structure as a trailing stop and you will notice a totally different ball game. So the smartest way you can manage this trade is by market structure. Following market structure, what do you do? Now that you've entered this trade, let's say you entered this trade, this is a 1 hour trade. You entered on the 1 hour, you saw the signal, you came in, you dived into the market. You could, by James Tilstead's strategy, you're supposed to hold this trade and you keep monitoring this trade until it hits 1.5 arrow mixed reward, right? When it hits 1.5 arrow, that's reward level, you then move to break even. So what this means is if you had entered this market right here, you would currently be at break even. So you are not losing any money in this trade. If you had entered this one, I'm not saying you should enter. But another thing you should also take note of is, as the trade goes by, you will find yourself holding a trade if the market is literally going to start a real trend, right? You're going to find yourself holding a trade that will end up producing 1 to 2, 1 to 3, 1 to 4, 1 to 5, and roughly infinitive, because it's going to continue like that. So let's look at the scenario. Let me look for a market where we had like very good trend. Or in fact, this same market right here. Let's assume you were on the 5 minutes, right? Just to show you exactly what I'm talking about. Let's assume you were on the 5 minutes and just looking for a very beautiful case scenario. So this doesn't happen every time. Again, this is like cherry picking the best case scenario or one of the best case scenario. So let's assume you were on the 5 minutes. And you enter this trade right here, this one at the TPT top. When you enter this trade, you hold your stop loss here and you follow the market. You don't just follow market structure on your time frame. When you see the market has moved long enough, far enough. So when I say long enough, not in terms of price distance now, but in terms of time distance. So you enter the market on 16th at 8 a.m. That's around 9 a.m. And it's currently, let's say the next day. You've been holding this trade, the next day arrived, it's 17th. You've literally held a trade for 1 day. You entered on a 5 minutes time frame, a scalping time frame. But now you are now trading like a swing trader because you're now holding, or rather a full day trader. You're now holding trades that run all the way into a day. You're not supposed to be monitoring this trade on the 5 minutes anymore. Why? Because the market structure on the 5 minutes is literally noise at this long time spent. So the longer the trade lasts, the more you switch up to a higher time frame. Basically, you switch up to the 15 minutes. You switch up to the 15 minutes. This trade has lasted way too long for 15 minute structure to be holding it. So let's say after a long time, you're still holding it. Assumption. Again, this is just assumption. And you're still holding it. And now the trade has moved so far. It's way beyond something you should be monitoring on the 5 minutes now. You can see that you're now seeing a lot of noise on the 15 minutes. You can switch into the 1 hour. On the 1 hour, you're holding this trade. You're still holding this trade somewhat, right? You are one of those guys that have very hard belief in yourself. You're still holding this trade and this trade is still running. At this point, it's no longer 1 hour situation. It's something that has gone beyond the 1 hour situation. It's something you should look at how long you spent. Thursday to Tuesday, it's been 4 trading days. Thursday, Friday, Saturday, Monday, Tuesday. So 4 Forex trading days. You spent 4 days in this market. Monitoring a 4 days price movement on 1 hour is not making much sense, right? It's beginning to see whipsaws. So you switch to the 4 hours. The 4 hours, you still have that same guts you have. You're still holding this same trade. It's the same trade you've been holding all this time. And currently, it's here where it is. Let's assume the trade continues to rally. It continues to drop, right? And it doesn't stop. You're still holding this trade. It goes to the daily. At some point, do you know what happens? Do you know what has happened? At some point, let's go back to the 4 hours. At some point, this trade started up at small loss and going, and now you are 6 times in profit of whatever you risked. At some point in time, you are actually up 9 times the profit risked. You can see this was the lowest point ever, and now price is here. So you can be monitoring this trade, just holding it and letting it run as time goes on, following market structure as you switch time frame. By this time, obviously, your stop loss will no longer be all the way up here. Nope, your stop loss will now be this high on the 4 hours. If price should break below those 4 hours and continue, you can then switch into the daily time frame and say, okay, in the daily time frame, what is price doing? Where should I move my stop? That is the way it is. James Tilstead strategy placed inside market structure is a new ball game. But how do you look at market structure with this whole situation? Again, that is why you have this indicator here. You look at market structure like this. You're looking at market structure like this. So on the 5 minutes where you enter the market, you see price making beautiful lower low and lower highs. Oh, sorry, that was a mistake. I'm going to have to pin this on the chart. So you're watching on the 5 minutes. You're watching the swing structure of the 5 minutes. Remember, swing structure minus structure, substructure. You're looking at the swing structure. You have a lower low, you have a lower high. You have a higher low and a higher high. So market has started going against you. Let's assume you saw this against you movement and you decided to hold on, which is you having guts. You hold on and price did what? Price sank even lower, creating a lower low. On the 5 minutes, you've had your first notification to switch your move to this one, right? Also remembering that when you switch into the 15 minutes, you remember for a fact that this was the lower low of the 15 minutes. Being that price has broken the lower low of the 15 minutes, you can now switch into a 15 minutes chart and hold your trade. At the 15 minutes chart, what are you waiting for? You're waiting for price to break below the lower low of the 15 minutes. This is the lower low of the 15 minutes. This candle right here. When price breaks this lower low on the 15 minutes, this is your stop loss. Don't forget, the stop loss is right here. You move your stop loss to the last higher high. And time has gone for so long. Let's go into the 1 hour, right? Move into the 1 hour. You hold the trade and you're like, where is the lower low of the 1 hour? And you are hoping for markets to do what? Continue to break to the downside. If you have faith, I don't know where you get this kind of faith from, but if you have this kind of faith, it's a miracle. This is your lower low for the 1 hour. You're waiting for price to make a lower high. When price made the lower high, you move your stop loss here. And this means you will be exiting this trade at this point with roughly 4-1 over a time frame of how many days? This is Thursday to Tuesday. You've held the trade on the 5 minutes, a very tiny stop loss, and you've been able to rally it all the way till roughly 3.5 hour. Now that price has closed you out, what are you doing? Is return back to the 5 minutes, waiting for another entry to pop up that you would hold. That is one aspect of it. Real big, real good aspect of it. What is the other aspect of it? Well, you can also use it to refine James Tilstead's entries. How do you use it to refine your entries? So, unlike this one where you start from the higher time frame and you follow the market to the lower time frame, in this other case, you understand the market structure of the higher time frame to determine which of the entry signals you will take as important or not on the lower time frame. I have one example here right now. I think I'm currently in one. I don't know if it's positively is going good or not, but let's see it. Perfect. So it's not going so good and I want to see it. So let's take a good look at the situation. If you go to the daily time frame of this market, right? On the daily time frame, I have my fibs showing me the high, the lowest. Now mind you, the fibs is also showing you this Fibonacci sequence here from the indicator is showing you the swing, the last swing structure. So this, you can see this dotted line is showing me the last swing. So on the daily, this is the last swing from the down to the up, so it's an uptrend. Now in an uptrend, if market is making moves to the upside, I expect a pullback. Standard market structure, we did it before. We have price doing this, so when price does this, we expect what? A pullback before it does what? It continues. So at this upside, what are we waiting for? What are we looking for? We're looking for chances to what? To sell, looking for opportunities to sell the market. And how do we do that? Well, it means that since on the daily price is currently in a very high space, how do we start to look for why should we sell? Well, we go down one time frame and we look at what's happening. So 4 hours later, what do we notice? We notice that price has been able to make breaks to the downside on the 4 hours. Remember, we're on the daily. We've seen that price has started to make breaks to the downside on the 4 hours. If price is making breaks to the downside on the 4 hours, then it may lead to that clear pullback we're expecting on the daily time frame. Since we're expecting clear pullback, we can then follow this Fibonacci sequence. So where's the Fibonacci sequence currently? It's here. This is the Fibonacci sequence. We have this low to the current highest high price has. If we expect price to fall, to go down, it means on the lower time frame, we should be looking for sell signals. Only sell signals. I'm going to dive into the 15 minutes. So from 4 hours to 15 minutes. And what do we have here? I have a sell signal here. I'll take this trade, stop loss above this low, above this high, waiting for price to continue to the downside. On its own, that is good. However, a less risky approach, because this was a risky approach, a less risky approach is to wait on this 15 minutes and wait for it to print a change of character. So if price goes down below this higher low, like this, so if price does whatever price is doing currently and goes below, it will create a change of character. When price creates that change of character, we wait for a pullback, and in that pullback, we'll be looking for sell signals. So sell signals, the moment we see a sell signal, we take it, stop loss above, entry there, and we start to hold the market. So right now, what I'm doing is I'm basically holding. If the market goes against me, it's fine. I lose a small calculated loss and we move on. So this is a combination, like I said, it's a combination of two strategies, combining market structure with a strength indicator or currency strength divergence indicator. So knowing, not that you would suddenly know where to buy and sell, just to give you one last example, but it tells you areas to start looking for sell, areas to start looking for buy. Just for one last example situation, what I have here is I have an indicator. I'll take up my Fibonacci just for you guys to see what I'm talking about. So the Fibonacci is telling me the last swing structure is from this high to this low, right? And it's a drop, so it's a selling situation. I'm looking for opportunities to sell. Remember, James Tilstead prints buy and sell at random. As soon as it sees currency changes, it prints. It doesn't care whether the market is going up or down. The entry is simple: strength divergence, print entrance. Strength divergence, print entrance. So we have this strength divergence showing you to buy here. Now I have my fib locked on the higher time frame. What am I looking for as an entry? I'm looking for price to rally into the premium zone. So this higher zone, this higher area, anything above 50% is premium, right? And I go 1 hour to 5 minutes, right? I go into the 5 minutes. I'm looking for one of two things. For example, right here, we have a reason to enter the market, but I'm not going to enter and I'm going to explain why. But a reason to enter the market is this: above the 50%, we've had a change of character. Now, change of character signifies that the market is changing direction. So it's changing direction from uptrend to downtrend. It just signifies. It doesn't say the market is going to and will continue. No, it just tells you, okay, we're about to change. That's what change of character is. So it has shown us a change of character. But why am I not selling? Why did I not sell? Well, I did not sell for one reason. This is way too close to my 50%. You can see this is the 50% here. It doesn't mean it won't work. It doesn't mean that the market will change and go back. For my own trading style, too close to 50%, I do not want to enter. Two reasons. One is it's too close to 50%. Second reason is it didn't dig into, for me, I use supply and demand, as you all know. It didn't dig into my supply zone. So this is on the 1 hour. This is my 1 hour supply zone. It hasn't mitigated my 1 hour supply zone. It doesn't mean price must come back here. No, it means price, I'm personally waiting for price to come here before I enter a trade. Price could do this and continue. It's valid. It is his business. If it continues to that drop, if it continues that drop, simple, what I will do is I will focus on the next swing structure. So what's the next swing structure? Is when price breaks below this low. So that will be my next swing structure. I will focus on the next swing structure. I'll remove this and wait for price to find every supply zone above its 50% price movement. Now, taking a look at this situation, what would make me sell this market? Just from exactly what I said. I have two options. I have two-factor authenticator, basically. So what I have is, I'm waiting for price to make its rally into the supply zone. So basically, I'm actually using three-factor authentication. I have supply and demand. So supply zone. I also have the swing structure of this time frame. And then I have James Tilstead telling me this currency has flipped to sell. So again, I have supply and demand, which is one strategy of its own. I explained it in the video before. I'm going to attach the link up here. So just do to click it if you want to understand supply and demand on its own and understand it separately. Then we have clear market structure. So just like I'm seeing this exact, you see this thing I'm seeing here right here, this break of structure and then change of character. If I get to see that up here, break of structure, change of character, I have two reasons to sell the market. Price has gone into my supply zone. Price has made the second reason to sell. The third reason I would crack my mind, like I would lock myself and say this must be a strong sell, is when James Tilstead, maybe inside here it printed an entry. Let me just use a highlighter to just leave it permanently marked on the chart. So we have this situation, right? So this is the situation. Let's say when price did the pullback, price has already given me signals by James Tilstead to sell here. I'm just going to start chilling. The moment I see any new one from James Tilstead, enter, stop loss above, take profits, none. Again, remember, there is no take profits, you just trade. So that's basically it. That's basically it for me. Hope you guys understand this whole video. It's long, but it's majorly for you to understand how to use the indicator. If you're looking for this indicator, the Telegram channel in the link below is for you. Do also hit the subscribe button on this channel. We do this a lot, not just on the channel, but on the Telegram group. Teaching everything we learned and spreading the knowledge and trying to learn together and get better at trading. See you all. Peace.